Hi everyone, it's Amanda here. You know, one of the biggest mistakes I see real estate investors make is mixing their active income along with their passive or rental income on their tax return. At first, it might seem simpler to just put everything under one LLC or one company. But here's the truth. That setup could actually cost you thousands of dollars in taxes that you could have otherwise avoided, and also create a big problem when it comes to asset protection, leaving a lot of your assets exposed to potential lawsuits. Today, I'm gonna break down why you need to keep your active income and your rental income separate, what are the right entity structures for each of those, and how money should be flowing between your different entities. First, let's talk about why mixing everything together is dangerous, right? And why does this mistake happen? Well, usually it's as simple as convenience. Investors think that, hey, I already have an LLC here for my rental. Now that I started doing a property management company for other people, I'm just gonna run it through one and the same thing, right? And that way I don't have to deal with multiple entities, spend money to set up another LLC. But here's the problem with that. First, bad asset protection, right? So let's say you have rentals inside the same entity as your fix and flip business. Well, if a lawsuit happens because something goes wrong at a job site or the buyer is gonna sue you for work that wasn't done correctly, well, guess what? When they sue the entity where you're flipping from, and if that happens to hold your rental properties, now all of your rentals are at risk as well. So all the equity you've built up, then everything is now all in the same basket, which then exposes you to potential problems. So from the liability protection perspective, this is where we typically want your rentals, AKA assets, separate from your active business, which is where the liability exposure is. All right, the next reason why we want to separate out our active income and our rental income is for tax purposes. Active income, such as property management income, fix and flip, commissions, or consulting that you might do, is subject to not only federal and state income taxes, but also self-employment tax. That's right, that's where we pay into Medicare, Social Security, and all that good stuff. On the other hand, rental income is usually not subject to self-employment tax. And yes, this is true even if you are claiming real estate professional status or using the short-term rental tax loophole. Now, what if you accidentally combined these different types of income all together? That means we have a scenario where you might either lose out on your ability to save on self-employment taxes, or you might be losing out on tax benefits. Let me tell you why. If you have an entity in a structure such as an S corporation, if you're flipping or earning management fee income from there, we can use a strategy that we call the salary dividend split. And this means that I pay myself a salary from my corporation, I'll pay payroll taxes associated with it. The rest of the money that I take out in the form of owner distributions or dividends, I don't have to pay that additional self-employment taxes on. So great, right? This is why I have active income in an entity such as an S corporation. On the other hand though, if I held my rental in the same entity, in our scenario, S corporation, then I may be limited in terms of how I can personally benefit from some of these tax benefits that are phenomenal for real estate investors, such as depreciation. So if I want to preserve the depreciation flow through tax benefits without meeting potential limitations, then I want to hold my rentals in an LLC and not inside of an S corporation. So now that you know the reasons why they should be separated, let's talk about the correct structure, right? The good news is there is a simple fix for this, and that's simply separate your activities into different entities. So here's the general framework, like I said. For S corporations, we want to have our active income in there. Things like flipping, real estate commissions, property management, or if you're just doing consulting or marketing. And the S corporation helps you to minimize self-employment taxes. Now, how much of a savings am I getting? It really depends, taxpayer to taxpayer. But as an example, if you made $100,000 of net profit from your S corporation, you might save anywhere between $7,000 to $8,000 in self-employment taxes every single year just by operating it into an S corporation rather than an LLC. Now, the other side of this framework is for rental real estate, right? I mentioned that we want rentals in LLCs. And this is, again, your long-term buy and hold strategy where you want liability protection and the ability to use these powerful tax deductions. Why do we have an LLC for rentals? First, it's flexibility. We have the ability to move properties in and out if we needed to for loan purposes. Sometimes a lender will say, hey, I only will lend to you in your personal name, in which case you might have to move your rental from your LLC into your personal name. And another lender might say, hey, actually in the refi, I need it in the entity, so then now you have to move it back into the LLC. What we love about the LLC is that it's super flexible. There are no income tax issues typically when you move properties in and out of an entity. And also something I alluded to earlier, when you own rentals in an LLC, you generally get to have the flow through benefits of depreciation and write-offs and things like that without having to worry about limitations. The tax term, we call it basis limitation. You don't have to know what all that means, but just understand that is something that is unique to S corporations and one of the reasons why we typically don't like to hold rentals in S corporation. Now, here's the most important rule about having this framework of active income in S corporations, rentals, and LLCs, and that is that these entities do not own each other, okay? That's a common misconception we see all the time where investors will split them up, but they have one owning the other, and then that kind of unwinds all the strategy. So the right way it works is that you, as an individual, will individually own each of these entities. So the way it works is Amanda will have an S corporation for my active income, and separately, Amanda will own an LLC that holds my rental properties. So from that perspective, I am the only connection between those two. So if something goes wrong and they sue the S corporation, well, my rentals are not held there. My rentals are held in a different entity that is owned by me. Now let's talk about how the money should flow, right? Walk through how do we move money from one entity to the next, because I get it, it happens all the time where, hey, if my active income business is making all the money, but I want to take the money and buy rental properties, what do I do? Does it create more taxes? So here's the breakdown. So your S corporation, where your active business is, it's going to be the money machine, right? So the S corporation is going to make profit, and then you are going to get income from there in the form of payroll, right? The W-2 that you are paid from your business, as well as owner distributions, and that's as simple as you taking money out of the business. So now, after payroll and distributions, the money has been liquidated from the S corporation to yourself. If you wanted to use the money to invest in real estate, it's as simple as you then putting the money from your personal account into your rental LLC account, and then once it's in the LLC account, it could go out and buy rental properties. There are no tax problems with you contributing money into your LLC. It's not taxable income to the company, and you're free to make those contributions whenever you want, as frequently as you want. Again, this is a way for us to take money out of our S corporation into our personal name, and then personally contribute to that into the LLC, so the LLC can then go out and buy rental properties. Notice what doesn't happen, right? The S corporation then does not own the rentals because the rentals are owned in my LLC. And the rental LLC does not flip properties because the flipping and the management, all that happens in my S corporation. One entity does not own the other. The one entity also does not manage the other. They're totally separate companies. And each one stays in its own lane doing what it's supposed to do. So let's make this practical. If you run a property management company, it should not own your rental properties. If you're doing fix and flips, that entity should also not own your rental properties. And if you own rentals, that LLC should not start flipping houses or start managing rentals for other people. Why? Because mixing them defeats the whole purpose of tax planning and asset protection. Now, you might save a few $100s in setup fees, but it could cost you tens of thousands of dollars in the long run. So don't take that shortcut. Don't try to put everything in one and the same entity just to save on a little bit of entity costs. So here's the bottom line, right? Active income and rental income should never live under the same roof. They're going to be different entities. We want to consider using an S corporation for active income. Again, it's going to depend on what your income level is and a lot of different factors. We don't ever want to use an S corporation to hold rentals. Rentals should be held in LLCs or trusts. And remember, you own each of these entities, but they don't own each other. And that's it. That's how you keep your tax savings, maximize your write-offs, and get asset protection by splitting out the different types of income that you're generating. If you found this helpful, hit the subscribe button and check out my free tax savings toolkit in the description below. It's packed with strategies to help real estate investors save on taxes and build long-term wealth.